Good evening, everybody. This is Jean Raddick. I'm the Presbytery leader of the Presbytery of the Highlands. I see a lot of names and faces that I've seen in the past. Uh, welcome back, and those of you who are here for the first time, we welcome you also to this workshop. Our workshop tonight is about uh, investments in the market in today's culture and today how things are going today. And we have Brad Masters from New Covenant Trust will be with us, and he'll introduce the other folks that have come with him. All I ask is you put your microphones on mute to, you know, uh, cut down on the background noise and coughs and stuff like that. And also, if you have questions, there will be points to ask questions. But if you have a burning question, feel free to put it in the chat and we'll try to get to that. People will be watching the chat to maybe answer your questions or to make sure we come back to them. So let us pray, and then I'll turn it over to Brad. So let's pray. Gracious God, we give you thanks for this day and this opportunity to join together to talk about how we can best help our churches in their financial sustainability. We ask that your spirit be with us and bless our presenters, and may that all that we say and do be to your glory. Amen. All right, Brad, I'm going to turn it over to you.
All right. Thank you, Jean. Good evening, everyone. My name is Brad Masters. As Jean mentioned, I'm the Vice President of Client Engagement for the New Covenant Trust Company. We are the wholly owned subsidiary of the Presbyterian Church Foundation. I'm sure most all of you have heard of the foundation. The trust company is, we're making our way out there. We've grown a lot over the last, 10 to 15 years. And I don't know why this is, but we do a lot of work. We serve a lot of churches throughout the entire state of New Jersey. And we are really grateful for that opportunity to serve. We are grateful for the opportunity to present to you this evening. And as Jean mentioned, there are two other colleagues on with me right now from the New Covenant Trust Company. James Carey is here from the home office along with me. James is the Director of Investments and Portfolio Management for the entire organization and the trust company. And he'll be doing the majority of the presenting this evening. And Ryan Cassidy is also here from the investment.
You know us. We go on for. Go ahead.
All right. Hey, and Ryan Cassidy is here as well from the investment team working there with James. And Ryan is here because he is based in the Northeast. We have grown to a size now within our team where within the trust company, we need to have folks that are scattered throughout the country and not all just based in the Jeffersonville, Indiana home office. So Ryan would be a name and a face for you all to get to know. He serves as the portfolio manager or investment officer on many of the accounts for the churches and mid-councils that we are serving there in the northeastern section of the country. I'll mention another name, Catherine Babich. Catherine is not with us this evening. This event lined up with some travel plans that she had for a friend's wedding, but she is a part of my team, the advisor team for the trust company, and she is based in New Jersey. I want to say Brielle. I may not be getting that right. Is that right? Brielle, New Jersey, somewhere that direction within the state. So Catherine as well, very closely situated to all of you. And lastly, but certainly not least, Rose Niles, your Presbyterian Foundation regional representative, or as we call her, your ministry relations officer. I believe will be joining us shortly if she's not already on with us. So we're going to walk through a few slides. I'm going to provide just a very quick sketch. James is going to lead us through these just to, again, further introduce you to the trust company, again, who we are, who we serve, how we serve, relatively quickly, as I said, so that we can get to James to dive into really the investment content for the evening. So I've mentioned the trust company owned by the Presbyterian Foundation. We were started back in 1998, really to expand the investment management capabilities under the foundation. As a trust company, we are a nationally chartered, federally regulated financial services firm. So we are held to the same industry standard rules, regulations, kind of best practices, if you will, audits, examinations, all of those things. So, all that to say, as we like to say, we don't get a pass on the investment details because we're nice church people, right? So we are held to those highest of industry standards, fiduciary standard of care. And so this is the work that we do. We are focused exclusively on serving Presbyterian churches, Presbyterian institutions, mid-councils. We care deeply about supporting, sustaining, thriving, healthy, and creative ministries through the local church. That is our call in our ministry here. In terms of size or assets, the foundation overall has about 2.6, 2.7 billion in total assets. And of that, the New Covenant Trust Company manages about 770 million. You can see the reference there to 450 clients there and growing, with asset sizes ranging from just a couple 100,000 up to, I think our largest now is at 35 million. But most of the churches, the clients that we serve, kind of are in that, three, four, $500,000 to 5 million. That's just where a lot of the churches and the mid councils we serve are at about that size. And again, we strive to take really good care of everyone, no matter the size of your account. So James, next slide. And again, for us, this is partnership in ministry. Every dollar that is in our care, that has been entrusted to us, is in some way, shape, or form connected to the church. Whether we're serving a church, a presbytery, an individual, right, a synod, a seminary, of whomever. It is all about supporting, again, ministries through the church. Across the country, I'll say, and this is, I think, for the mid-council folks here, we now serve over a third of the mid-council organizations, the presbyteries and the synods throughout the country, north of 50 to 55 presbyteries, and again, majority of the synods. So about 160 million of that 770 is mid-council focused. And so we are looking for ways just like this to expand how we support and collaborate with mid-councils, right? Through providing educational content, workshops, anything that we can do to support you in what you are looking for from your foundation / trust company. We would love to provide that for you. Mentioned our work throughout New Jersey, but specifically in Highlands, we are serving several churches in Highlands, totaling somewhere 14, $15 million. We are there often having meetings, running together with Rose, but again, looking for any opportunity that we might have to meet with you to best serve to meet your needs. James, next slide. 21 folks are a part of the New Covenant Trust Company team. We've got a few of us tonight, but diverse group, again, experienced, well-educated, right? All the credentials that you would expect to see from folks that do this kind of work. A team that is also focused on our faith, right? We're all church folks. Not all Presbyterian, right? But folks who just love serving the church, faithful people ourselves that look to provide, again, client engagement services, account administration. The investment work is very important. We have a very robust compliance program and are, again, focused on really delivering anything and everything that you would expect from any secular firm that's providing financial services to you, right? So we're held to the same high bar that they are. James, please. So again, you all know Rose, I would assume, right? Your foundation person. She really is the point person in your area for all things that you would need. So Rose is your go-to. If you reach to Rose and you want to have an investment conversation, Rose is pretty quickly going to redirect you to us. But for the churches that we are serving, you do also have on your team a financial advisor, which would be like Catherine from my team, right? You're going to have that investment officer from James, his team, which in this case is Ryan Cassidy. And you'll also have a day-to-day point of contact for all things administratively focused, right? We need to update signers. We need to put money in, take money out. I'm having trouble with statement. All the normal things that would go along with the day-to-day oversight and administration of investment accounts are offered and provided directly by our team. Next, James. Again, statements, online access, all of the normal industry standard things that you would expect to receive, newsletters, communications, again, guidance, advice, the types of things that we are following and that we are tracking in the markets and in global economies, some of which we'll talk about tonight, right? You'll have ready access to all of this content, again, delivered directly by us and through our team. We like to meet virtually. We'd certainly like to meet in person as often as we like to eat when we have these meetings, right? Good church folks. Let's eat and have a good conversation. But that's really that's the intro to who we are as an organization. I think we're about to maybe dive into the investment content for the evening. And if that is okay, James, are you up? Gene, can
Right.
we pause right there? Anybody have any questions about who New Covenant Trust Company is? Glad to pause right there just about the organization before we get after the investment discussion.
Just go ahead. Either raise your hand or just speak out.
Yeah. Anybody? We can't see
Brad,
it.
what's the minimum deposit for New Covenant?
Yeah, so let's just go with the quick answer is a lot of grace, a lot of flexibility around that, right? We don't have a stated account minimum, but I will say, generally speaking, 200, 250 would be a good a way to start the conversation. For other, smaller amounts, perhaps we would certainly want to talk. There are other options that are available, but that's just a good kind of ballpark for intro conversation with the trust company. I hope that helps. Can't give short answers. I apologize. Right. Anybody else?
I guess I'll ask one other question.
Please.
On your funds that you use, do you list the administrative overhead costs for those funds as well?
We do. We most certainly do. And that's a part of those early stage conversations. Talk about, and we may get into this some more, but what our investment philosophy is. We talk about any screening, socially responsible preferences, those kinds of things, but are able to break out very clearly what the cost is of our fee plus the cost of any underlying investment vehicle. That's all very clearly presented. Good question. I should say we're a fee-based operation, right? We charge a fee for our services. So we're not compensated on commissions or trades or anything else that you might encounter out there in the industry. So again, that fiduciary lens and open architecture platform. So we use a lot of industry standard, right? Publicly available, daily priced, investment vehicles that you can research on your own as well. Good question, sir. All right, I do see that Rose, I think you've joined us, Rose. Hi. All right, there's Rose. All right, so at this point, let me hand things over to James. James, if you want to provide any other intro information for yourself, but otherwise, let's have fun.
All right, here we go. Well, thanks, Brad. And it's kind of like an HBO show, right? It's like this session is now sponsored by, now that you've listened to the commercial, this is all the meat and what you're here for. So we will talk just about markets in 2025, and this is your time. So please do drop a question in the chat, even interrupt in the course of a slide, that's fine, but we will have some time at the end dedicated for questions as well. So great to be with you. Good evening. As Brad mentioned, I'm James Carey, Vice President of Investments for New Covenant Trust Company. I oversee our portfolio management and investment strategy functions, chair our investment committee, and really happy to be with you this evening to talk about 2025. It really has been, at sometimes, a really stormy and scary and not so fun to be working in this industry type year. And then here we are, all the way back again to new record highs. It's been a very volatile period. Expect the unexpected is sort of the headline of our current mid-year market commentary. And I think it really is a helpful summary of how we're thinking about markets moving forward through the rest of 2025 and into 2026. We've seen markets down from record highs by 20%, and we've seen markets up from 20% from those lows, both in the course of about 4 to 5 weeks, which are sort of the fastest bear market in history and one of the fastest recoveries in history. So in some ways, it's not super surprising that we've had a volatile and unexpected, unpredictable start to 2025, given the results of the 2024 election. And many people were expecting there may be more unexpected surprises than usual heading into 2025. But even with that sort of standard, things really have been choppy, to say the least, in 2025. And we'll be talking about how we're positioning portfolios and how we're thinking about these markets moving forward, given that sort of context that we're facing in today's environment. So the big winner in 2025, we're going to start a little bit with the big picture philosophy underlying our investment approach, because I think it will really add context to the recommendations and to the commentary at the end for this specific period. If there has been a winner in 2025, it's been the fundamentals of investing. Football teams have to not forget about blocking and tackling and not fumbling the ball. Similarly, investors, there's a handful of things that if you do well, you're like 90% of the way there. And some of those things like diversification, for example, has been a huge winner in 2025, as at times the US markets were down as much as 15, 16, 20%, and international markets were flat or even a little bit up. Having that global diversification was really helpful at the bottom of the bear market in 2025. Sectors like value, sectors like not technology, were doing really well when technology was really the one that was driving things down. Diversification is like chapter 2 in Investing 101, but this was the sort of fundamental, the sort of basic that really held portfolios up in 2025. And it's those sort of fundamentals that underlie our investing approach. And so we're going to just start with a couple of those key fundamentals just to kick us off. So just to start, one of the things that we, say about our investing approach is that it is an evidence-based approach to investing. Everything that we do is going to have some sort of academic finding, academic paper, empirical data set. There's going to be data, there's going to be evidence for the things that we are recommending or advising as it relates to investing. There's a large body of work, both academic and industry, that sort of tells us what are the things that really contribute to investors actually being successful over long periods of time. Everybody will tell you about their big winner. Everybody will tell you about that time they bought Tesla in 2013 and stuff like that. But they don't tell you about the 11 losers that have been a part of that portfolio. And so we're going to ask for the evidence. We're going to ask for the big numbers, the data in everything that we do. And just as an example, one of those pieces of data is the fact that when it comes to these gurus and these sort of market magicians that get on the TV and say that they have the crystal ball and that type of thing, when you really look at the report card and you really look at the evidence, those crystal balls really do not work, especially in certain asset classes. So on the screen here is the S&P Dow Jones SPIVA report, comes out every single year. This is the 20-year look at some of these asset classes. And the orange part of this pie chart are the number of managers in that asset class that underperformed their benchmark. So large cap core, that's the S&P 500. Of 100 managers in 2003 that started, 3 managers ended 2023 actually outperforming the S&P 500. 97 managers underperformed the S&P 500. So we look at that evidence and we look at specifically that asset class, and we're going to say, okay, well, this is probably not the asset class where we're going to pay high fees and we're going to pay a manager to have the crystal ball and try to beat the S&P 500. This is one where we're probably going to try to match the S&P 500, do so at very low fees, and guarantee ourselves the outcome that outperforms a large chunk of our peers. Just for example, this is the evidence-based approach informing some of the things that we recommend as investment managers. Another thing about this sort of preoccupation with beating the market is the fact is the market return has been pretty good. It's been nothing to sneeze at. If you look at a dollar invested since 1926, at the end of 2023, it was $14,557 in the S&P 500. The long-term average return for the S&P 500 is 10.5%, 10.5% per year. If you think about the law of 72, which is a sort of financial, heuristic, the rule of 72 says your money will double in 72 divided by your return. So if you have a 10% return, your money doubles every 7 years. This has been the outcome of just owning the S&P 500 and holding it for 10, 20, 30, 40, 50 years. 10.5% per year, just earning the market return is pretty good. And so this preoccupation with trying to beat it and then having a 97% chance of failing to do so, this just isn't supported. We don't have a strong conviction that that's the right lottery ticket to try to win on. We really follow some other much more sound approaches that have been shown to really contribute to success. And so if it's not, having the crystal ball and trying to beat the market, what really is it that we're doing? Well, this is another large study. This is actually a meta study. This has been replicated a number of times, a number of different ways, really exploring what is it that explains an investor's long-term return over time. And again, started in the 70s and it's been replicated a number of times. This was one from Vanguard in the mid 2010s, showed the exact same result. Over 90% of your return as an investor is explained by your asset allocation, your mix between stocks, bonds, and cash, your mix between US and international markets, your mix between large cap, mid cap, and small cap. This explains over 90% of your returns. Even though it's often what gets a lot of attention in finance committee and what we like to talk about at the barbecues and stuff like that, picking stocks, timing the market, chasing the hot fund, that explains less than 10% of your return over time. And as we saw before, is overwhelmingly likely to lead to underperformance, suboptimal performance, rather than really outperforming. So we look at this bit of evidence again from Nobel laureate types that started with this type of research. And we're going to look at this and say, okay, well, we're going to really focus on asset allocation. We're going to really spend a lot of time at the beginning understanding and getting this question right of how we should be allocated based on your needs, goals, and objectives, based on your spending formula, based on your liquidity needs. We're going to get this asset allocation optimized and really do no harm here. Again, just another example of using an evidence-based framework to inform what really matters and focusing on those things that lead to success. So if asset allocation is so important, you would think that it's going to be really, really complicated and really, really hard. But the fact is, asset allocation is actually really easy. I have not come across a finance committee that cannot answer the two questions that is all that you need to really be 90% of the way there when it comes to asset allocation. All you need to be able to answer is, what do I need these assets to do? What do I need these funds to do? What is the purpose of the goals of these monies? And two, when do I need this money? What is the time horizon of this investment? If you can answer what are the goals and objectives of these funds and when do I need these funds, then you will be really a lot of the way there in coming up with a really sound asset allocation. And this is the sort of framework that we take people through to do that exercise. So from left to right on this screen, you will see different time horizons from basically you need the money right away. You need it like this month to make payroll, to you'll need it in the short term, to later, to much later, 7 to plus 10 years, multi-decade type time horizons. And we know that in finance, there is no free lunch, right? So everything is a trade-off. And the trade-off that we see is because of this liquidity, because you can get it instantly, and because $100 today is $100 tomorrow, what you have to pay for that sort of stability is low returns, basically low returns, low volatility. So as you come across this sort of timeline, you'll see that as you expand your time horizon and as you enable yourself to, let's say, have some funds earmarked for long-term growth, well, then your ability to earn higher returns is there because you can withstand short-term volatility. It can go down because you don't need to touch it for a long time and you can allow it to recover. And putting your assets sort of efficiently along the spectrum will allow you to ensure that anything that you need in safety right here is here when you need it. And that's pretty important if you need to, pay off the roof or, fix the boiler or something like that. I mean, you need that money to be here, about as much money. You can't be down 20%. You really want it to be there. So you have what you need safe and available when you need it. But if something is able to be earmarked for the long term, then you're taking advantage of what markets offer you as a long-term investor, and you're going to pursue those higher returns for those assets. And again, if you can just answer those questions, when do I need this money and what are my goals and objectives for this money, then you can really be a lot of the way there in efficiently allocating assets according to this framework. And again, we know that that explains over 90% of your returns as an investor. A lot of committees, zoom by this. A lot of committees give this short change and go straight to what's the five-star fund, right? But this is really what matters. This is really where you can hurt yourself or help yourself as an investor. And getting this right, again, is really the main thing. And we like to keep the main thing, as much as we can as investors. All right. So from there, if you're optimally allocated, you have a good asset allocation. From there, you really just try to not make mistakes. Don't fumble the football. I mean, you guys just really, well, came down the field. Everything's looking good. Don't throw a silly pass. Don't make a fumble. Our human nature is such that we are wired to be terrible investors. Our human nature, our instinct, our gut really makes us want to be bad investors. This is sort of a funny cartoon. It's kind of famous, but we have this sort of euphoric markets. Everybody's talking about, these great tech stocks and how they bought this stock at this price and all these types of things. Makes us really want to get in and buy. It's usually right about here at the top of these markets, right? And then when everyone's panicking, when the news is talking about the market, when, you look at statements and they're down, this is when we really want to panic sell, right? And it says repeat until broke. This is the cycle that our human nature sort of wants us to be, buying high and selling low, basically wanting us to be terrible investors. If you want a more sort of serious look at this is the sort of evidence-based data on this sort of topic. This is the Morningstar Investor Gap study, published every year, famous study, essentially showing that your performance as an investor is almost always lower, always lower on average versus your investments. So investors that own an S&P 500 fund almost always underperform the S&P 500, for example, because they want to buy stocks as soon as stocks are doing well, and they want to dump stocks as soon as stocks are doing poorly. And we buy these funds when they're hot, and we sell these funds when they're down. And on average, consistently over time, the study is published every year, investors on average underperform their funds by about 1.1%, because they sell them as soon as they have a good run, a good 3 year, they're buying them, they're dumping them as soon as they have a bad quarter, that type of thing. And on average, in the aggregate, in the law of big numbers and the big data, investors are doing this all the time. And this is a easy mistake to avoid. It's an easy thing to not do, but so many investors do it in large part because we're just sort of wired that way in many ways. But when we look at this evidence, when we zoom all the way out, we can sort of help this inform how to really invest well, to do well, and also on a relative basis to our peers and to others to really do well versus our benchmarks and versus other sort of indexes industry wide. So those are the sort of fundamentals. Those are the sort of play defense and shoot free throws to investing. We wanted to start there before we talked about 2025, just so we had a good starting point for these topics. Again, in summary, the investing fundamentals as we see them at the New Covenant Trust Company, at the Presbyterian Foundation. Start with your goals and time horizon. Discern an appropriate asset allocation. Get this right. Put the time in to do this. If you want to, Brad and I will come. We'll do Panera or pizza or whatever it is, and we'll roll up our sleeves and just get this right. Let's do the work to get this right, because this is so much of it. To have these funds in the right buckets, in the right place, so you're not having to sell something after it's down. It was supposed to be short term, and you don't have something sitting in cash for 10 years when it could have really seen some growth. Document and memorialize your plan in a written investment policy statement. This is really important for the governance and for everybody to be on the same page, but also for new committee members, for as soon as all the institutional knowledge rolls off the committee, that type of thing. It's really important to have this documented and written for a number of different reasons. From that point, execute your efficient asset allocation through investments that are expected to earn market returns over time. Again, we looked at those market returns. They're pretty good. US stocks, 10.5% per year. Most people underperform that just because they're trying to beat it. They're so preoccupied with beating it. 10.5% per year is pretty good for most folks. Look at investments that are low cost. Look at investments that are broadly diversified. We haven't talked about this, but to the extent that you want to be in any way socially responsible as an investor, are you looking at investments that sort of speak to your values? If there are industries that you don't want to own or do want to own, for-profit prisons, military weapons, assault weapons, things like this. We have conversations a lot where the investments have to be consistent with your values, and you really need to do that well, because you can sort of get in portfolios that say that they're green, but they sort of miss some of these fundamentals as well. And so we look at that a lot. and have consistent and repeatable investment processes. Not something that just is all of a sudden 5 stars because they had a great 3 year because they're 70% technology. We're looking for something that is consistent, repeatable, not just lucky, for executing that asset allocation. From there, just don't make mistakes. Don't fumble the football. Remain disciplined to your documented plan through market cycles. Succeed by avoiding mistakes. Investing is a interesting area where sometimes doing less is doing better. Sometimes, saying, hey, we had a good plan. We had a good plan last quarter. All of a sudden there's storm clouds. It doesn't make it a bad plan. We have a 10-year time horizon on this. Why are we worried about a month? These types of things, that sort of perspective, that type of zoom is sometimes really helpful when we face those storm clouds. And if you've done your work and you've allocated assets efficiently, you know that anything you need in 1 to 3 years is in safe investments, and anything that is over here, subject to the stock market, is in longer term investments. And so you have a lot of comfort knowing that your assets are in the right places, and anything that is subject to the stock market, which can be volatile, is there for the long term. And there are ups and downs, but over the long term, investors face bear markets, bull markets, recessions, expansions, and earn about 10.5% per year. And so that's that comfort level of knowing that you allocated your assets correctly. You're really appreciative of that when there are sort of those storm clouds and volatility. We'll begin talking about 2025 in a moment, but I will pause right there. It looks like maybe we got one question in the chat, and I'll give it just a second to see if there's any big picture questions before we talk about the specific market in today's economy. Brad, anything to add?
No, I just think hopefully with the group, what you're hearing here is that there are really two key aspects of these kinds of engagements, right? James is talking about the planning work, right? We need to understand the role of the funds that you have as it relates to their purpose for the church, your mission, your ministry. Figure that out. What short, mid, and long, right? What are liquidity needs? Any, again, screening preference, right? The planning work before we actually get into the nitty-gritty investment work, so which I think is coming next. But I'm glad to help with any or all of it. I think it's a really good question in the chat. If it's okay, we'll hold on to that one until the end. But James, that's well done. Let's talk about this
All
crazy
right.
year we're having.
Keep rocking and rolling. All right. Well, what is that playbook? Sometimes I got to be careful with sports references. Hopefully you all haven't been, you guys have been okay with the football references. But what's the playbook? What's the playbook for 2025? What are we going to do here? Well, if we look at 2025, as we look ahead in particular, we really do view three key themes as the main thing that are likely to drive the markets in 2025. Number one is inflation and the Fed. Number two is tariff and trade policy. And number three is artificial intelligence. And we will talk about each of these sort of individually. But starting with inflation and the Fed, the reason why inflation and the Fed is so important, inflation was obviously critical to markets in 2022 when inflation really spiked. The stock market in particular does not like inflation. And finally, we're in this position entering 2025 and all through 2024, where we see inflation sort of consistently coming down from those really high levels. And now it starts with 2, which is pretty good. I remember when inflation started with 6, and that was pretty bad for stock markets. So now it starts with 2. That's pretty good. The June inflation number came in at 2.7 headline, 2.9 core, more or less trending in the right direction. But now that we're in this position where inflation is looking pretty good, we slap 10% tariffs on the entire world. And that is a real thing. And there is a tug of war going on with economists and with markets, where there's a camp that says tariff inflation is going to be very transitory. It's going to be very mild. It's not going to be that big of a deal. And there's another camp, and I think may sound a little bit more reasonable, that says, there's going to be an impact on inflation. Anytime there is a 10% tax in the economy, there's going to be an impact on inflation. These were just announced in April. They went into effect sort of mid-April. You had April's inflation report. It wasn't going to be there. You had May's inflation report and June's inflation report. We've only had 2 inflation reports. In our view, there is a risk that we will begin seeing inflation going in the wrong direction. And currently, the market in general, as we sit here at all-time highs, record highs, higher than we were even before the tariffs, markets are really discounting that everything's going to be okay. there really is a sort of optimism, a sort of nonchalance to markets that inflation is going to be okay, tariffs are going to be okay. And in investing, you're always forward looking. You're always saying, not necessarily what do we think is going to happen, but what do we think is going to happen relative to what markets think are going to happen. And for markets to go up, things need to be better than what markets think are going to happen. And for things to go down, things just need to be a little bit worse than what markets think are going to happen. And right now, markets think everything is fine, tariffs are fine, inflation is fine. And so, in our view, that's a real high bar to not have anything go wrong as it relates to inflation with just the early bit of data that we have on that topic, and tariffs, which we'll get to next. In our view, there's a number of ways that there is some downside risks, some real risk that we could see a return to the choppiness, in large part just due to at current prices, markets are pretty much pricing in no big issues. Everything's going to be fine. And I think on inflation, that's one area where we may see some issues. That's really immediately impactful in markets in large part because of interest rates. And interest rates, again, it's not what is going to happen, but what is going to happen relative to what's already priced in of happening. And right now there's 4 interest rates priced in beginning in September. So expectations are that the Fed will begin cutting interest rates in September and have 2, 3, or 4 between September and next summer. So that's already priced in at the current stock market levels. The Fed has 2 mandates. Their mandate is to keep stable prices, which is essentially support low inflation, and to support full employment. So they want to sort of have the economy be healthy and have people be able to, not be in a recession and losing their jobs and things like that. So they're tasked with 50% of their job is to make sure that inflation doesn't get out of control. If they see inflation spiking up because of tariffs in the coming 1, 2, 3, 4 inflation reports that we get, they are not going to be on track for 4 rate cuts in the next 2 or 3 quarters. So in our view, again, everything is sort of, is it upside risk or downside risk to where we are? And in our view, interest rates are providing some downside risk because everything is so optimistic. Everything that's priced in is so optimistic that can definitely be a little bit disappointing, a little bit worse than expected. And then now you throw in the Fed's real, I think, interest in signaling that they are an independent organization and that they have to have their independence detached from politics and specifically detached from the executive branch or from a president. And that, any sort of danger to the global market's perception of an independent Federal Reserve would also be damaging. And so again, we think there are just more risks to the downside than risks that it's going to be better than expected, specifically as it relates to this inflation and the Fed. I'm going to try not to sound like a real downer through this entire thing, but I think it is important just to understand what we're thinking and how we're positioning portfolios given that outlook. Again, it does just generally make it harder when the standard is so high. Markets are priced to perfection. Markets are priced that everything's going to go really, really well at these new record highs. And as it relates to tariffs, I think that the issue has really been largely ignored. This is the picture of the sort of famous tariff press conference that began the 7-day bear market. We fell 20% from February highs. And, what we rolled out in this sort of tariff rollout are orders of magnitude, tariffs that are orders of magnitude higher than have ever been seen in 100 years in the United States. And even the current tariff level, we ended up with what we were going into that press conference as the worst case scenario, 10% across the board tariffs. That was sort of the relief. Oh man, it's only 10% across the board tariffs by the end of what we saw through this saga. So as of today, the tariff level that is actually being charged in the ports is around 12 or 13%. We entered 2025, it was around 3%. It hasn't been above 4 or 5% in 60, 70, 80 years. These are the highest tariff levels that has been seen in a long, long time. And so with this being the case and with the data still being young and we still don't know quite what the inflation numbers are going to eventually look at, and we don't quite know if we even have deals with a number of these countries that are left, Um, with the market pricing in, I think the tariff issue is going to be okay. I think everything's going to be fine. These were negotiating tactics, right? In our view, there is downside risk from that price level. That well, now we're going to play hardball with this country, or now we're going to play hardball with that country, or now we're going to, um, you know, uh, really even begin to see some impacts from the tariffs that we have, which have not fully flown into the economic data. So, in our view, with tariffs and trade, expect the unexpected. This is probably the primary way that we're thinking that way in the near term. Expect the unexpected on this issue, and in our view, sort of more risk to the downside than that. There's going to be deals that just blow the market socks off that we're just not thinking about at this point, in our view. Now, finally, artificial intelligence. So the reason artificial intelligence is on here because there is a real trade in markets right now that when we hear about issues like the U.S. deficit, the U.S. debt, issues with the U.S. dollar, spending, and sort of the cost of interest on our debt and things like that, when we read about demographics and how there's demographic challenges in the US and globally for workers and sort of, the number of people that are turning 18 every year and how that looks in 50 years and that type of thing, which otherwise would be viewed as very challenging for the economy's outlook. There's a real sense and a real, I think, trade in place in markets that artificial intelligence is going to provide a sort of productivity boom to the US economy specifically, but the global economy even more generally, that is going to be at least as much of an impact as the internet, as the personal computer, and even as electricity, which brought upon the Industrial Revolution. And there's this sense that we are going to be able to grow our way out of our debt problems, that the economy is going to be able to grow its way out of a number of these structural issues that are otherwise going to be real problems if we face a slow growth phase, if we face a sluggish growth decade. Then these issues like the debt and these issues like demographics and these issues like a tight labor market are only going to be exacerbated, which is inflationary and is sort of just negative in a number of ways. And so this idea in 2025, as we've now sort of gone from this sort of artificial intelligence intrigue, like, oh, this is cool in 2023. Have you talked to ChatGPT? That's kind of fun. To now in 2025, executives, business leaders, businesses are rolling out AI in their businesses. And there are real ways that you can see that a hospital system could benefit from this, that a trucking logistics firm could benefit from this, that coding is already, I mean, computer programming coders already hugely involved with artificial intelligence. We're going to see the sort of impact, not just in NVIDIA and in Microsoft and in, these companies that are commercializing AI. We're going to begin seeing impact from businesses that are implementing AI and getting more out of their workers and getting more out of their sort of inputs based on AI. And that's sort of the base case for markets. So if that doesn't happen, if somehow it disappoints, if somehow we don't grow out of these issues via AI boom in the next few years, then some of these headwinds on the market are really going to be hard to overcome as it relates to deficits, as it relates to debt, as it relates to interest rate expense, as it relates to the labor market. And so it may not be a real near-term spark of volatility. If we see any near-term volatility, probably because people are disappointed in NVIDIA's earnings or something like that. But in the longer term, 1, 2, 3 years from now, if markets begin to really be disappointed by what AI is doing to revolutionize the economy, then I think more structurally and more longer term, we may see some real sluggishness in markets and in growth because the picture will become clearer that optimism that's been baked into this view that's led these markets to these new record highs may have been overdone, and AI is frankly not going to save us. One of the main reasons there's little market impact to a lot of the budget discussion that went on in recent months is because there's still this view that we'll be able to grow our way out of it. A lot of that hope is built on hope for AI. And so it'll continue to be very closely watched issue, not just in the second half of 25, but probably for the next 5 years. It'll be critical to the market's thesis as we move forward. So, as investors, we want to skate to where the puck is going, right? Not to where the puck is. You got to skate to where the puck is going. So, what does that mean? Now that we are at record highs, it's been a great 6 years, right? 5 of the last 6 years, we've seen 19% returns at least on the S&P 500. 2 years in a row, 23 and 24, 25% plus gains. We're up again in 25. So things have been really good, but where are we going from here? In our view, the risk is to the downside. We're at new record highs, valuations are stretched, price to earnings ratios, which is sort of like price per square foot in real estate, very, very high historically, towards their 10 years highs, which is naturally going to probably be a little bit more risky to the downside just because you're already so high. Um, Investors should prepare for volatility and unexpected surprises and not be surprised or panicked by that sort of correction in markets. If anything, the every once in a while 10 to 15% correction in markets is actually pretty healthy. It actually means that markets still work and people haven't completely sort of lost the fundamentals of investing. In our view, now is a very attractive time to evaluate replenishing cash reserves. When we talked about that asset allocation timeline and you had your immediate needs, your 1 to 3 year needs, those should be safe. Those should be in money market, CDs, short-term bonds. We're still seeing yields above 4% easily across the curve. 1, 2, 3, 4 year CDs, still getting 4%. Now's a really good time to sell stocks and replenish those cash reserves so that if there is volatility in the next 3, 6, 9 months, it feels really good to have a year of cash in that type of situation. And a lot of our folks in April really felt that way when we face that. So now is a really attractive time to replenish cash. It's also a really good time, now that we've done this sort of investing 101, to think as a committee, are we allocated correctly? Do we have our accounts that have stocks in them for funds that have 7 year or longer time horizons? Do we have our long-term funds in these stocks? Because now's a really good time to rebalance if you need to de-risk portfolios. Had a huge run in markets over the past 3 years. Really good time to say, okay, yes, this is all earmarked for 7, 10 plus years. This is actually sort of shorter term. We should probably go ahead and fund this bucket with some of these earnings from markets in recent years and sort of fund these shorter term projects, these shorter term buckets, ensure that anything in stocks right now has that longer term time horizon because we may face some correction even naturally since we've gone up so much. Evaluate portfolios, make sure they have those evidence-based aspects to their composition, broad diversification, balance, evidence-based investing strategies, low fees, broad diversification. And when the inevitable volatility hits, seek to zoom out to the appropriate context. If you look at a 100-year stock chart, it pretty much looks up to the right, right? If you zoom into a 90-day stock chart, it's a complete roller coaster. And if you're going to be invested in these endowments for decades, have that decade-long zoom when you're evaluating these day-to-day news cycles. And in this environment in 2025 and probably for the next few years, we will see news cycles that are rapid and we will see things that happen fast. And it's important, I think, to keep the appropriate context if you're a multi-decade investor when things are moving so fast. Long-term investors will be invested over decades. We'll see multiple cycles of bull markets, bear markets, expansions, recessions. The average return over 100 years is 10.5% per year. But I will say almost any single year is almost never 10.5%. So it's plus 26, it's plus 29, it's minus 30, it's plus 1, it's minus 8, it's plus 21. It's never 10.5. You have to be invested for a long time to get an average return of 10.5. So it's a really good time to raise cash. It's a really good time to evaluate your asset allocations. And otherwise, if you have everything in the right place, that's a great place to be when everything's going on and there's so much noise in these markets, to really just relax and say, we've got the appropriate zoom. We can get through this quarter. We can get through this 6 months. We can get through this year. We've planned for this. And that's a really good place to be when the volatility hits. And we are expecting the unexpected for the rest of 2025. So with that, I will thank you. Thank you for your time. Looking forward to any questions. And Brad, I'll turn it back to you to kind of close this out.
James, really quickly, can you flip back to slide 13, just the market emotions real quick?
Yeah.
Just to reiterate the point for the group, we have actually lived through this just this year. If we could put some dates on this page where it says greed and buy, that would say, December 31, 2024, the end of last year. Then you flash forward to February, March, April. Oh my goodness, right? The bottom fell out and nobody was very afraid, right? Very unsettled. And all of a sudden here now, May, June, July, we're right back up to our highs. And so we have lived this journey, right, together just this year. And so taking this, it does connect back to the advice that we are, again, high level, we are generally sharing with all of our church and mid-council clients, right? Just as it relates to this, let's good time, replenish cash, markets are high again, right? Contrasted with where we were all of a sudden in February, March, right? Our advice then was because we're having this extreme volatility, we've had a big correction. This is not the right time to sell. This is not the right time to raise cash. Let's wait, right? And see if the markets can recover, which they have. And now we're having the same conversation again about downside risk to the market at this point. So I just wanted to connect this just to the advice, how we generally approach these conversations at a high level. And then ultimately those seek to filter them down into individual conversations, with you, with your committees, with your sessions, on a very individualized level. So I'm okay to drop the screen share, James. I think
All right.
the content is available. I believe Gene was going to post this somewhere where you've got our contact information again, to have those follow-up conversations. But we've got, I don't know, 10-ish minutes for some questions. Gene Raddick, is that okay?
Yeah, sounds great.
Okay. I'm okay to start with the question that's in the chat and just to give everybody time to maybe formulate any others that you have. And it's a question from Bruce. Good question, Bruce. And I don't know if everyone can see that, but a reference there to liquid investments generating lower returns, which is a true statement, right? So cash reserves, all the way to the left of that slide that James presented, CDs, treasuries, money markets, right? And as churches connected to one another and to the presbytery, would it make sense to create an emergency fund in the presbytery so that I guess maybe the short-term cash needs could be met that way, and then additional longer-term investments could be invested for higher returns? I hope I'm capturing that right, Bruce. I don't know if you're able to clarify that. Are we interpreting that
Yeah,
correctly?
you're right on. And I just say that because usually long-term investments do better. And if you're not worried about the short-term liquidity issue, then you can go ahead and be very aggressive. But if everybody is always concerned about a little liquidity, that means there's going to be a lot of money corporately in the presbytery that's all being invested in very, very low return type investments, rather than saying, hey, let's create almost like an insurance company within the presbytery. Let's all contribute to an emergency fund that the presbytery would hold on to. It would take care of those short-term emergencies and let everybody try to be as aggressive as they could in terms of trying to get the highest returns.
Sure. I think there's maybe a couple of aspects of that, and I'll just speak to, I would say that from our experience serving churches, we are seeing many local churches do what you're describing, right? Having their own reserves and being really careful, really sharpening the pencil to figure out what they're going to need over the next 6, 12, 18, maybe 24 months. Put that into cash, right? So that you've got your cash needs met. And then with the remaining assets, right? Maybe to your point, increase the risk. So take that portfolio from 50-50 to 60-40, or from 60-40 to 70-30, right? So there's our safe stuff, and let's dial up the risk and the opportunity for higher returns with longer term. So we are giving that general advice to the majority of our clients. They're just implementing that sort of themselves in a local church context. Okay, so it's a fantastic idea. Definitely tracking with you on that. Now, as it relates to creating sort of a pool at presbytery level, everyone would, those that wish to participate, contribute, and that I'm not sure that's for us to weigh in on. I will say though, it's a conversation that we are hearing about in other parts of the country. It's how can we sort of pool resources to meet different needs. And I should probably be quiet on this at that point, Gene, and that's right, a good conversation for you all to have as a presbytery. I think it's a cool idea in the theory, but the execution, the implementation, little bit unique. So, um, if anyone else wants to add anything to that, James or Gene, Brian, Rose, there's that. Okay, Bruce, that's a really good question. Appreciate that. Anybody else? We have some time. Hey, Jane, Miss Jane.
I have
Hi.
a question. What is available to us in the new covenant funds beyond the income fund, the growth fund, the balanced income, the balanced growth?
Sure. So that's a really good question, Jane, and let's Rose be ready. Let's tag team on this one, okay? So we want to be really clear with the group to draw a distinction between the New Covenant funds, Jane, which I think was your question, and the New Covenant Trust Company, right? These are very confusing naming conventions, both of which fall under the larger umbrella of the Presbyterian Foundation, right? But the New Covenant funds are a self-directed investment option that are they're a family of mutual funds. You just rattle them off, right? Very
Yeah.
nicely done. They are managed according to Presbyterian values, but they are different and distinct from the New Covenant Trust Company. So those are the four options that you have in the New Covenant funds. I think there is also a money market option. It's called the Treasury Obligations. There's a money market fund. So sort of this general framework that we're describing, you can implement with the money market option through New Covenant funds, right? And then invest the rest in the balanced growth or the balanced income. Okay. But for those that are in the New Covenant Trust Company or want to explore the managed account services that we offer, the menu does get a lot bigger with the New Covenant Trust Company, Jane. So in the New Covenant funds, the only other option that you would have there is the money market fund. Rose, am I missing anything?
No, it's the Hermes Treasury Fund,
Yeah.
money market fund. So, so it's the bane of my existence that they call them the same thing, the New Covenant funds and the New Covenant
Yeah.
Trust Company.
Same, right?
So, making sure that some churches just really love the New Covenant funds, but they're managed by a great company called SEI, but they require you to watch your own pots, I like to say. If your pot's going to boil over, nobody else is watching your pot for you. So if you're in the balanced side of things, the balanced income or the balanced growth, then it will be automatically rebalanced. But if you set them up so that you have some growth and you have some income, you have to watch your own pots. And you don't have the same back end supports that you would have with the New Covenant Trust Company. That's the difference. But they're
so-
great. There's some churches that just really love them.
All right, so just to clarify then, if it's the New Covenant Trust Company, what you've described tonight is how you look at investments in the foundation funds. Is that correct?
That's close. Right? This would be a reflection of how we in the New Covenant Trust Company are managing and advising clients, which are local churches, that we are managing their local church money, right? And other presbytery money. So we're not managing the foundation money. We're talking about local church money for churches in Highlands Presbytery.
Where are those funds held?
I'm sorry.
Where are the funds held? In the trust company?
Yes, ma'am. So yes.
Okay.
Yeah. So I wonder maybe Rose, if there's a way, or Gene, if we can follow up with Jane to kind of have a good conversation there about those, differences. That's a really good question, Jane. Thank you for raising that.
Thank you.
Yes,
Oh,
ma'am.
and I think, James, maybe you could talk to how the same principles, the same fundamentals inform the foundation's approach to investments.
For the New Covenant funds, Rose, or even for the permanent fund. I mean,
Yeah,
certainly,
even for
really
the
it all-
large endowment pool
yeah.
that we have.
The large endowment pool is managed with very similar principles, and even the New Covenant funds are managed with very similar principles. Now, the New Covenant funds are not going to asset allocate themselves, so that's a self-directed program. Whereas a New Covenant Trust Company is a full service program, and you'll have a team of advisors help you do that along the way and sort of monitor that with you over time. But the investment philosophies and the investment principles that we sort of laid out at the beginning are pretty uniform across the foundation family, including the New Covenant funds, the New Covenant Trust Company, and the permanently endowed permanent funds that the foundation is fiduciary on. So that part is the same. That's a good call out, Rose.
Any other questions, Gene? Are we at time, or can we hang on for a second? Or you?
If there's more questions, we're at 8 o'clock. So do we have any more questions that you'd like to ask, or?
I feel like I'm remiss in mentioning something that I know Rose would want me to reference, and maybe Eugene as well. Did we lose Gene Raddick?
No, I'm here.
Okay, there you are. You moved. My screen
Oh,
moved.
sorry.
I lost it. Sorry. It's referenced in the slide deck, and I just didn't call it out specifically. You know, I did talk about our work in mid-councils, right? We serve a number of presbyteries, including Highlands. Longstanding, very collaborative relationships, and we're really grateful. It's something we have come up with in the New Covenant Trust Company, right, for clients of ours. Again, many churches in Highlands, and certainly others that we would welcome a conversation with. But for the churches in Highlands Presbytery that wish to explore a conversation and an engagement with the trust company, because of your presbytery's investment with us, the constituent churches in the presbytery would receive about a 20% reduction to the investment management fee that we would charge. So lower fees for member churches, definitely a part of how a connectional church should work. We're a part of your national agency. They are your mid-council. It's us putting our time and talent and treasure together to make life a little bit better for the local church in the way of lower investment management fees. So glad to talk about that some more. Sorry I didn't call it out beforehand, but you should know that in Highlands Presbytery.
I was just going to mention that.
Thank you. Go ahead, run with it.
Yeah.
Sorry, but we're back in commercial land, but that's an important data point, really, for everyone there. What else, you all? We could stick around. Any other
I just want
questions?
to say that from my standpoint as your ministry relations officer, if any of this, like you want some clarification, you want to see some more, you want to know about different options, please do reach out. That's what we're here for. That's what I'm here for. Like the Maytag, they used to say the Maytag repair person sitting by the phone waiting for a phone call.
And
So
she answers the phone calls. Rose, why don't you put your contact in the chat?
Yeah. It is also included, Gene, at the end of the deck. I don't know. Are you able to post that?
The deck is already posted
All
on
right.
our webpage
Great.
for the financial sustainability. And when we send out notices, we'll, have a link directly to that, but it's already there. And somewhere within the next week, this video will also be posted on the webpage.
Come on, questions. Let's go. It's okay.
Just to kind of end out, the Presbytery has been working with the Covenant Trust for longer than I've been here. So over
15 plus.
13 years, 15 years, was set up with them through Keith Woods. Some of you may remember him from Newton Presbytery, who did a great job helping us navigate this from a presbytery perspective and work with New Covenant Trust. So we've been with them. We're very satisfied. All of our investments are with New Covenant Trust or with Presbyterian Investment and Loan Program. Those are where we have our investments. Seeing no other questions.
There's Gene.
Oh, there's Gene. I
Woodman.
see Gene. Yeah. Make sure you say it right.
Other Gene.
Always come in a little late, but maybe say something about the environmentally conscious options that are offered. I know the fossil fuel free portfolio was a big seller for Coastlands.
Sure. Maybe I'll start, James, if you don't mind, if it's okay. So yeah, it's right. So how we engage in that conversation is, it really just starts with your preferences as a local church or a presbytery as it relates to expressing any values through your investments. The New Covenant Trust Company has the ability to screen or not screen, all right, and can engage there to listen, to learn, and to understand how you as a local church would like to have your investments sort of constructed. we have been asked over the years by the denomination to implement a couple of additional strategies that are screened. There is a fossil fuel-free investment strategy as well as a diversity, equity, and inclusion investment strategy, right? So we're able to incorporate those kinds of things in addition to just, right, the normal Presbyterian values, right, as defined by mission responsibility through investment. So we are able to implement those kinds of portfolios, adding other things, taking some things away, and really just to ultimately reflect these are your funds, they're in your care. How would you like to see them invested up to and including, please don't screen us at all. Like we can do that too in the New Covenant Trust Company. That's a long answer, Gene. James, anything else?
I'll just say we do run a fossil fuel free strategy. It's done great. It's got almost 10 years of track record now. It's actually been a pretty good investment to be fossil fuel free lately. So, but everything I would say is driven by your individual organization, your values. Every session has to define that for themselves. Every congregation has to do that for themselves. But we are very flexible. And I will, just say that there are positive investments that are available as well. So positive impact bonds, where a portion of your bond fund will fund affordable housing, for example, or fund renewable energy projects and things like that. So there's the divestment angle, there's the positive impact angle, and we also vote proxies, which I can really nerd out to as well. So the last thing I'll say is we can be very informative in giving congregations, donors information on the positive impact type of investing as well. So we can do a webinar on that type of thing. But it's a whole other topic, but we're very involved in that area. So thanks for asking.
All right. Well, thank you everybody for joining us on this on a July. We know that that's a sometimes challenge, but we're trying to keep moving our financial sustainability project forward. We have several more webinars lined up. I think there's still one more to be scheduled, but for those who are in the financial sustainability project, our final meeting will be October 11th. It's a Saturday, and it will be at the Chester Church where we started, and more information is coming out on that soon. So thank you again. Thank you, Brad, James, Ryan, Rose, and everybody else on your team. And let us close in prayer. Gracious God, we give you thanks for all the opportunities that you place before us. Help us to discern where you are calling us next in our mission, our ministry, our finances. However, what is the best way that we can serve you? In Jesus' name we pray. Amen.
Amen.